Hello, my name is Theophilus Tego. I'm a financial student ambassador for the Society for Financial Education and Professional Development. Through the society, I work with college students on building their personal money management skills with an emphasis on budgeting, credit and debt management, and investment. Welcome to Fundamentals of Personal Money Management. This lesson is investing, credit, and debt management. In this lesson, we'll examine the principles of investing, the concept of compound interest, and the different types of personal investment tools that can help grow your income. Finally, we look at best practices for managing credit and debt. I'm presenting this concept to you in general terms. For information on specific personal money management, you should consult a qualified financial professional. Effective money management is an important skill because it helps you reach your financial goals. It involves focusing financial resources to meet your current and future financial needs, as well as your financial obligations. One aspect of money management that will play a key role in meeting your needs at each stage of your life is investing. Investing involves committing some of your money into assets with the hope that it increases in value. As a result, you create wealth and income for your future. When you are putting money into a financial vehicle, you are seeking the benefit of the potential growth of your investments. Consider ways to start investing a small amount of money early, so that through the power of compounding interest, the value of your investments increase over time. Two of the most important concepts about investing are simple interest versus compound interest, and how each factor into how your money grows. Simple interest is calculated and paid on just the principal or the money you deposited into the account. In contrast, compound interest is calculated and paid on both the principal amount plus all the previously accumulated interest earned. Think of it as building blocks. Simple interest is like adding onto the first brick laid every time. Compound interest is more like adding new brick to the last one you place at the very top. The wall gets taller, your money grows more substantially with compound interest. Money that is compounding is money at work. When you open a savings account at a financial institution, ask your representative if simple interest or compound interest will be paid on your account. Often, money put away for savings at home loses the benefit of compounding. But money put aside into a savings account earning interest that compounds frequently can make a huge difference as it increases its value over time. Let's look at an example. If $5,000 were deposited for 10 years, earning 6% simple interest annually, the account value in 10 years would total $8,000. But if the same amount of money were to earn compound interest, at the end of 10 years, the value would be $8,954, almost $1,000 more. In fact, the amount will reach $9,070 if instead of annual compounding, the interest crediting method allows for quarterly compounding. What does this mean? It means that instead of interest being credited once a year, interest will be credited on the accumulated balance every quarter, making the amount earned every 3 months slightly higher. The frequency of compounding daily, monthly, quarterly, or annually can make a big difference. In this example, the accumulated value in 2 more years will reach $10,000. This is more than double the original amount. Any subsequent growth continues to benefit from earning on top of the old earnings, so that as the accounts get larger, it grows exponentially. When it comes to compounding, the rule of 72 is a simple way to estimate how long it will take an investment to double given the fixed annual rates of interest. By dividing 72 by the annual rate of return, you can get a rough estimate of how many years it will take for a one-time initial investment to double. In this case, we will divide 72 by 6, our interest rates, to find that it will take the original $5,000 investment 12 years to double. This example assumes that not only the initial amount deposited, but the amount accumulated will grow much larger if you continue to add more into the account. Depending on the length of time someone invests and the rate of return earned on the money, it becomes apparent that the accumulated earnings can exceed the principal. By taking advantage of the power of compounding, you can put in much smaller amounts in early years and let the work of compounding do the work of increasing the value of your account. Delaying or starting later in life simply may not give you enough time to take advantage of accumulated growth over time. Even doubling or tripling the amount contributed on a monthly basis may not allow enough time to catch up to the account value of someone who started early with much less and allowed the earnings to keep growing. Now let's look at other types of investments which can also increase in value and create wealth and income for you. These are stocks, bonds, and mutual funds. Stocks are securities that represent ownership in a company. If the shares of stock increases, the value of your ownership in the company increases. Bonds represent loans in which a company or government entity is essentially borrowing money and issuing you an IOU, promising to pay interest and to return the amount that was borrowed at a future date. Mutual funds represent a combination of the two by purchasing shares in a grouping of stocks or bonds managed by an investment company. Despite the volatility historically, the average return over a given period of time on investment assets outperform what can be earned in safer interest-bearing accounts. Unlike a savings account that offers savers a set interest rate, money invested in stocks, bonds, and mutual funds does not have defined interest rate when you invest. Instead, these seek a rate of return on the investment. There's no guarantee of what you earn on your investment. There is both the potential for gain or loss, and there's no guarantee that money will grow. This is what we refer to as risks when discussing investments. Investing involves a risk-reward relationship. Generally, the lower your risk, which is found in savings accounts and certificates of deposits, the lower the return. Conversely, high-risk investments like stocks, bonds, and mutual funds offer a greater potential return on your investment. Investment vehicles such as stocks, bonds, and mutual funds tend to fluctuate in value based on various market-related and economic factors. While in most cases, historical return in this type of investment represents high overall gains, it should be expected that market or economic conditions may also result in negative rates of return or a lesser return than expected. Smart investing requires that you choose investments according to your time horizon and risk tolerance. Your time horizon relates to your life stage or the time you think you will need the money. Risk tolerance relates to your ability to withstand changes in the value of your investment that may occur from time to time. For example, if you are investing for retirement that will not come until 25 or more years in the future, you can afford to invest in a more risk-tolerant way, taking a chance on high risk, potentially high-return financial vehicle or two. Even in years of negative return, the account has time to recover and make up losses before funds are ever needed. If, on the other hand, you know you need the money being invested in 3 to 5 years, it makes sense to limit your risk exposure by making low risk, low volatility investment. While smart investment is but one aspect of your focus on the road to creating wealth, the issue of credit and debt management are vitally important to your financial well-being and economic stability. The mismanagement of credit and debt can drain your financial resources and limit your ability to make investments. Credit and debt management are those areas in which what you don't know can hurt you really applies. Credit is a powerful tool for wealth building. It gives you the ability to acquire goods and services today but pay later. Credit can be used to pay for your education, purchase a vehicle, help fund the startup of a business, or buy a home. When you are granted credit or use a credit card, you are essentially borrowing money and making a promise to repay it back, usually with interest. When you use credit to pay for expenses, you are committing or giving up the future use of your money. When applying for credit, potential lenders will look for these top 3 factors. They are called the 3 C's: capacity, character, and collateral. Capacity look at your ability to pay the debt that you are seeking. That is, do you have the income and resources sufficient to pay back the loan and maintain the payments? Character is a consideration of your creditworthiness. This refers to your reputation for paying bills when due by considering your past payment history with other lenders as an indication of your willingness and ability to honor agreements. Collateral is an asset pledged to the creditor until the debt obligation is paid. Example, if you own your home, it may be used as collateral to secure a loan. Management of credit is extremely important when it comes to your financial health because negative information on your credit reports follows you for years, well after an incident or late payment has occurred. Even if you are able to obtain credit, the cost of credit is increased in the form of higher interest rates. Another issue most people may not be aware of until it's too late is how credit is used by others in making decisions unrelated to borrowing. Employers, landlords, banks, service providers, and insurance companies use your credit history as an objective assessment in determining whether to accept or deny applicants, deny services, or charge higher fees. This can make a difference in what job you get, where you are able to live, or your access to choices in obtaining basic services. Prioritizing debt reduction now by adjusting your budget to pay more than your minimum payment can help you get on a better path to have more money to invest later. Money management is not simply about how you spend money. It's about considering and making disciplined choices. Despite having limited current resources, carefully considered financial choices that you make now have an influence on how you are able to build a foundation for your future financial well-being. Thank you for the opportunity to share how investing, credit, and debt management are tools for long-term financial success. For more information on this course and to access related resources, visit our website.